No, the yields are getting back down to the low end of that range, Kelly. As you pointed out, the low is 54 basis points from March 9th. That is something we're watching today. And also the price of oil slipping below $20 a barrel again. So those are two things we're watching today.
And what does that tell you about your investments? I mean, are you positioned for that, or does that, I mean, oil maybe isn't so much forward looking, but the bond market typically is.
Yeah, no. We're positioned. We're staying balanced, diversified. That's how we came into this. We look at rebalancing is what we look at, certain levels in the stock market. We know oil is a much lower percentage of the S&P 500 right now. It's one of the lowest sector weightings in the S&P 500, but still it has impacts on other parts of the economy. So in general, balanced, diversified, active over passive, U.S. over ex-U.S., and we're primarily staying with large caps over small.
Yeah, and I see a lot of tech names on your list as well: Microsoft, Alphabet, Amazon. And Dave, that's true for you as well. So, I mean, how long can Amazon remain the consensus favorite and continue to outperform in an environment like this?
Well, I think it still has some room to go. We're a little bit cautious there. It's getting so big in the portfolio. Maybe trimming makes sense, but at 100 PE right now, we still see upside. I mean, everybody's still shopping online, and you cannot buy but the essentials in a lot of these states that are locked down, which is all across America still, and just extended by Governor Cuomo. So we think that this is still a good position to hold in Amazon, and we're happy to have it. We do not see downside surprises here, and that's what we will try to avoid.
You also hold Walmart. You say you don't see downside surprises for Amazon, but do you have a view, Dave, on the stock market overall and on where the economy is going here? I mean, have we been too quick to rebound off the lows?
Well, absolutely, we have a view. And the reality is you compare this to history, there's a couple things that are for you and a couple things that are against you. The one thing that we've never had in history is such an active Fed. So an active Treasury. And now we have the stimulus package. But is it enough, and have we went too fast? Our view is yes. We're cautiously optimistic. We look for a rebound. We look for this stock market long term to be what it is and what it always been, is a wealth generation for Americans. But the reality is that we're up 25% off the lows. Yeah, that's a little bit too fast, too quick for us. The economy has terrible numbers coming out, as you just said. The unemployment now, we've lost more jobs. If you go back to March, we've lost more jobs in a month and a half than what we've gained for the last 10 years. That's a bad position to be in. And we feel like that it's going to be more of a choppy recovery and opening than rather a real quick one.
For sure. I think that reality is settling in. John Augustine, I'm curious why the David Tepper formulation no longer holds. You know, if you go back probably almost a decade now, during the early rounds of quantitative easing, he said, look, either stocks are going to go up because the economy is recovering, or they're going to collapse because it's not. The Fed will come in with more support, and then stocks will go up. Why aren't we in that kind of investing environment anymore, or are we?
Well, we think we're in a kind of what's the next phase environment. So, Kelly, we know that the economic numbers are going to be bad. You pointed that out in your article today, but we know we're going to get through this. We know we're going to get back open. What we're thinking is the depth of this recession is going to be deep, no doubt about it. It's the duration that's going to matter. Same thing with employment, the duration of those unemployment claims. So what our equity team is thinking about is the other side of this. What are companies on the other side of this, as you were just talking with Dave about? That's more of what's on our mind. We think markets are headed that direction too. However, with one caveat, treasuries, bond market's still doing its job, being skeptical in this environment. And we appreciate that and we respect that.
All right, Dave, I'll give you the last word, both kind of mentioning what's going on in the bond market. And the same kind of question I just asked John about that old Tepper formulation and why you don't think that's working right now.
Well, we're just in a new environment, and the Fed and how active they are, and we don't know if it's going to work. And so there's a lot of unknowns, and with the disease that we've never seen before, we don't know how it's going to play out. So I think these unknowns are keeping the bond market where it is, skeptical, and it should be, because there is a lot of questions to yet be answered. Being really good companies like a Clorox, everybody's bathing in Clorox, so it's definitely a growth company. A lot of healthcare companies out there are doing really, really well. Like you said, Amazon, Walmart, some really good names. Those are the names you want to be in. So if the market does go down, maybe not retest those lows, but does go down, you're in the names that you want to be in both now and long term.
I just wonder about the stampede for the exits in Clorox at some point, Dave. I mean, are people really going to need more? They seem to have a decade's worth supply right now.
Well, there's the change in behavior, right? We're never going back to not using Clorox. You're always going to have it on hand. You're always going to be buying it. Where it was before is not where it is now.